Hi everybody, I'm Dragan Dimovski, and today we're going to be discussing how to create wealth over 15 years using 4 properties and 4 properties only. And today, to help us, we're going to have a special guest by the name of Samuel Uno from Mortgage Choice, and as always, our lovely co-host, Amanda Calabria. Samuel, welcome.
Thank you, Dragan.
Tell me a little bit about yourself, Samuel.
Over my history, I used to be a chartered accountant, specialising in tax. After years of doing tax returns and helping small businesses grow, I decided just to get more into the property segment, because I love property. So I got a job at Wizard Home Loans back in the day, so a long time ago.
Amazing.
Developed my career over at Wizard, then at Mortgage Choice, Smartline, an REA group. And then I decided to become a mortgage broker, use all those skills over the last 20 years to be able to help clients the way that I can help them grow and basically develop.
Amazing. So right now you're at Mortgage Choice, you're a director?
Yes, I run my own franchise over in Baulkham Hills. Okay. And we've got a good team where our focus is just to really help people build their property wealth.
Okay, fantastic. So let's discuss this 15 years with 4 properties, how to build wealth. Now, a lot of people out there, a lot of listeners are going to think, oh, well, sure, that's, for people with a lot of money, or, there's some people out there that are very curious to know. Obviously, this is just for your average everyday Aussie who can start investing with just a minimal wage. Is that right?
Oh, absolutely. Look, I've based my formula, my table, based on 2 people let's call them 2 teachers. Sure. They've got good wages, just good middle-class wages.
So what would that look like? What would the numbers look like there?
You'd be looking at about $120,000 per person. So a family income, call it $250,000. Yeah. And how that we can take that sort of salary, that family unit, to be able to build on properties year after year.
Amazing. And with this formula that we have now, mind you, we're going to have this for everyone out there to download, but we're going to break it down. So this formula is very conservative. So do you want to tell us a little bit about that?
Sure, absolutely. Look, I've been an accountant by trade. I'm always going to err on the side of caution. So, and I know that any client that will be engaging with someone like yourself, you're going to be trying to get them into the highest capital, highest yielding properties, of course, around the country. So I've based it conservatively on an annual capital growth of 6%. Yep. And an annual rental yield of about 4.5%.
Okay, which is extremely achievable.
Yeah, which by Australian standards can be achieved very comfortably.
I guess a lot of the people out there are going to ask the question, in 15 years, what does that look like? What sort of income will I be, bringing in?
I think it's firstly, you've got to start with the position of you've got to make the right decisions. Sure. You've got to find the properties with the right attributes, in the right locations, in the right market, in the right part of the cycle. When you've got all those things, if you make the wrong decision on property 1, it cascades.
That's right. You're sort of setting your foundation with the first property.
Just to share my own personal experience, I bought my first property at the age of 22 with my brother in the early 2000s in the Sydney market. Yep. Obviously, that was the time where the Sydney market went through a stagnation over 10 years. So we held a property for a 10-year period without any capital growth. Okay. Now, if I had listened to someone like yourself and made the smarter decision back at property number 1 and maybe invested in a different market, early 2000s, Perth was booming. If we'd put our money there in Perth, I would be a far better position today than what I am based on those early decisions. So I'm just saying you've got to start with the right framework, start with the right foundation, then you can build wealth very quickly.
Okay, so for a client that does start with the right advice and the right foundation, they've gone to the right broker such as yourself that can forward plan, they've gone to the right buyer's agent that can find them the right properties in the right markets. Let's just say we've got a hypothetical client that does meet your metrics of that 6% growth per year and that 4.5% rental yield. Now, obviously, our goal would be to outperform that, but for the client that meets those metrics that you've modelled in your 15-year plan, what does the 15th year look like? What's their end goal?
The aim is to buy as many properties, buy those 4 properties as fast as possible. So then you can maximise the growth prospects and the yield, rental yield, over that 15 years. So if you're starting with a deposit of $162,000, to buy that first property, call it, let's say, $740,000 property, by year 15, you would have amassed $3.5 million worth of equity and have rental yield of $24,000 per month.
Per month.
Per month.
So once those are paid off, that would be, for example, the income that they might retire on. Once they stop working, their salary's gone, that rental income remains. Correct. That's what they would be living off.
I think by the time that you decide that you want to approach retirement, you may end up deciding to sell property number one and then use the equity of property number one to pay down the debts of properties 2, 3 and 4. So then it's very comfortable that the rental yield will basically cover the actual debt repayments plus leave an actual surplus afterwards.
And you mentioned that you want to be purchasing the properties very early on in this 15-year plan. So there's 2 phases to this plan, I believe, an acquisition phase and a consolidation phase. Can you explain, just for our listeners, what that means?
Sure. And so we start at year 0 and you're going to be buying property number 1. So that's the starting point. Getting that property in the right location, by year 3, you would have amassed enough capital growth to be able to take out the equity out of that first property via a cash out and then use that as the deposit for property number 2. By year 6, both properties would have gone up further in value. Then you do a second cash out against those 2 properties to buy property 3. As long as they keep on going up by the conservative 6%, by year 7, you would already have owned the 4th property. And by then, and look, based on the numbers, I've calculated that you've maxed out on your actual borrowing capacity.
On a $250K household
Correct.
Income? Absolutely.
So by then, you're carrying debt of about $2.5 million, but that's been covered by the actual rental yield. And then over the next 7 years, your journey is to basically pay down that debt and consolidate those 4 properties.
So for a household that might be earning more than $250K, or if we were as buyers agents to source properties that exceed that 4.5% rental yield, or if we purchase in markets that exceed the 6% capital growth that you've modelled on, this 15-year plan can be condensed into 10, 12, whatever. So these toggles that can be, I suppose, tweaked to clients' individual circumstances, how can that change the outcome for them?
Look, I think we can still base it on 15 years, but we just bring the actual properties forward. So instead of buying your 4th property by year 7, you may buy your 4th by year 6, and then you may be able to buy a 5th property by year 10. You need the properties to be in your possession for as long as possible. That's where you'll get the strong capital growth and the strong rental yield.
So it's certainly a long-term game, this property game.
Absolutely. And look, we've seen it over the last 20 years. If you've owned property in the right locations, you have far exceeded that 6% capital growth.
What about for those households that are earning less than $250K? You've said that we can tweak the plan for those that are earning more by condensing the plan. What about for those where they're not earning the $250K, but obviously we can still hit the other metrics like the capital gains and the rental yields, because we can obviously advise on achieving those. But if people are capped by their own income, what options do they have for achieving this wealth goal?
Even if you own just the one rental property and you've used that deposit of $160,000, by year 15, you would have amassed over $900,000 worth of equity. The idea is that you want to try to compound that. So even if you don't earn as much as that household of $250,000, or you may have children, or may have credit cards, or personal loans, or car loans, then even if you buy that second property by year 5 or 6, you can still amass wealth, maybe not $3.5 million, but you may be able to get $1.5 to $2 million.
So if we can tweak this and toggle this for any household, is there anybody that's actually locked out of this plan? What if somebody doesn't have a deposit? What options do they have?
If you don't have a deposit, and then I've always encouraged my clients, just try to get into the property sector by any means possible. So you may decide that you may try to buy something where you buy it as a first home owner, so you're able to access the first home guarantee scheme, having that low deposit of only 5%. But then once you've lived in that property, maybe move out somewhere else, then do basically rent vesting, where you're actually renting, where maybe in a modest one-bedroom apartment, but you're able to rent out your house and be able to get the actual tax benefits of having that property, the gearing working for you.
So it's really a case of seeking the right advice and knowing the options that are available to you.
Absolutely. I think that there's always an option available, whether that be like I've had clients that have come to me with difficult circumstances, low credit scores, and it's about giving them the guidance to put them on a path to be able to save that first deposit by any means possible. I think don't be afraid to ask family to be able to go as guarantor for you.
Yeah.
If they can't go as guarantor, maybe that they can like give you a gift. I think by any means possible, if once you get your foothold into the property market, you will never look back.
And that can also be like yourself, you did several years ago with your brother. It could be a family member, parents, maybe one of your partners that can come in with you and do a joint venture.
Look, absolutely. I've had clients that have bought properties, their first properties with friends, because you may not have as many lender options available, but it is still achievable. Look, my own personal circumstance, I bought my first two properties with my brother. By the time that we decided to basically find partners and get married, we then basically sold the properties to each other. So then we then by the age
you held one each.
Correct.
Yeah,
exactly.
That's right.
And then we put into a much better financial situation.
Yeah. There are ways, and look, even for the listeners out there, if you're unsure, you're not sure which direction to go, jump on. We'll leave a link below. Book us a 15-minute discovery call. We're going to help you as much as possible, answer any questions. If you feel stuck, give us a call and we can guide you the right way.
Yeah, for sure. I want to just look a little bit into the assumptions that you've made in your 15-year model, because when people, view this video and download the ebook that actually maps out year by year this 15-year plan, I just want to talk about the assumptions that are made in that plan, because we can stand here and say, look, we'll tweak this and toggle this to your individual circumstances. But when people are reading it, I just want to really be clear about the model family that 15 years was built on. So you mentioned the $250K per year income against the national average. That's probably about right for a household income based on the clients that you see?
Yes, yeah, well, exactly. That's my client base. I'm seeing, really 250 plus. The thing that probably you can't take into account just based on just a model is that, well, how many children does the actual family have?
Expenses.
Correct. And so I've used basic household living expenses. I haven't factored in children. I haven't put in, obviously, any additional debts. And then, obviously, the real biggest factor is what is their current living circumstance. So that's one of the things where you have to just assume that they've that they have their own place. So we're not taking into account any additional personal debts.
All right. So then the further assumptions from there, we've gone for 6% annual growth. How does that stack up against the national average?
Well, look, you're seeing over the last 10 years in Perth, whereas that market has increased over 80% just in the last 10 years. Mm-hmm. Whereas if you had that same money invested, let's say Melbourne over the last 10 years has gone up 20%. Mm-hmm. So it's about making sure that you're choosing the right market to invest in. And then once you've chosen that right market, that's when you can basically really maximise. So it's hard to say what is the national average because each market operates so independently of each other.
Yep.
So that's our job, is it, to hit that 6%?
Absolutely.
and look, that's one strategy. That's the standard strategy. There's also other strategies where we can look at properties where we can increase the equity through maybe adding additional bedroom, a little bit of a renovation, things like that.
Oh, it's absolutely, especially in certain markets. If you can buy a corner block and add a granny flat, suddenly you've turned that negatively geared property into quite a strongly positively geared property.
That's right.
And when you put in a granny flat that may cost you $100,000, the return on just that simple capital investment may be 25, 30%.
That's right. And I guess it's one of our jobs and one of our strategies is even if we are looking at particular properties and let's just say the market doesn't kick up to whatever we can always force the equity.
We can create that.
We can create the equity from that.
Yeah, and we've just had a recent change with some of the lender policy decisions that they will now accept a co-living arrangement. So if you are subleasing a room, let's say for $150, as long as that you've got a stat deck or an actual lease agreement, there are many lenders that will accept that income as a way to contribute towards the actual loan.
That's great, because that's actually one of our big strategies for our clients is co-living. And I know there's a lot of people out there that are a little bit scared of that, which I guess they shouldn't, because of the circumstance now with low vacancies and what have you. There's a higher demand for this. So again, and I'm going to get into this strategy into another video, or for our listeners out there. But on average, you can purchase a 750 house and get up to 1,000 to 1,100 rental yields.
Far more than the 4.5% you've modelled on.
Far more than that 4.5%, which then will fast track you to this particular strategy in a shorter period of time.
Well, that's doubling the yield. You're getting 9 or 10%.
Exactly. But we're sticking to just the conservative strategy here.
For the average client, though, if they were to come to you as a broker and you map out their 15 years, or we map out their 15 years and go, all right, property one, your target is something that'll earn or exceed your 6% per year and earn 4.5% rental yield, they would then come to us with that brief and go, right, these are the minimum metrics I need to stay on track for my 15-year plan. We then go, hey, let's go co-living, you're at 9%. Or you know what, if we need 4.5% and you're looking for capital growth, we can go for a 4.5% or 5% property in a market that's ready to rock and roll. And we can purchase based on this long-term plan. So when well, this is where property one is going to fall on your timeline, when you're going to be ready for property two, property three, property four, because you've mapped it out with the broker, you're mapping it out with your buyer's agent. As you said earlier, getting the first property right is far more important than most people realise, because as you said, if you purchase in the wrong market the first time, it locks you out of any market.
And the thing that I probably would add to any client, don't be afraid of lender's mortgage insurance.
Yes.
If you've got to pay $10,000, $15,000, $20,000 to be able to get into that property faster, that will pay you back fivefold.
Yeah, that's right.
Look, I've got a client that's in the early 2000s, stretched themselves like you wouldn't believe, and they bought a small apartment in Surrey Hills. Lender's mortgage insurance back then, it was like $12,000.
Yep.
That property is now worth 3 to 4 times what they actually paid. So, and then that they wouldn't even blink at that $12,000 because it's made them so much more capital than if they were to wait and try to. Unfortunately, you can't often save fast enough to be able to actually beat the actual property market.
Right.
But they also purchased in the right market at that time. Obviously, they got the capital growth choosing Surrey Hills.
But they also got the right advice as well.
Yes.
The advice at the time was buy in the inner city, buy in those close suburbs, close to the CBD, but the market's going to kick. So then they were like, so they took the advice, they stretched themselves, lender's mortgage insurance, but being in that market, great yield, great capital growth, and they were basically laughing all over the bank.
Here's a question for you. Let's compare that client. You said the Surrey Hills client purchased in the early 2000s, which is approximately the same time that you and your brother purchased together. Correct. And the Surrey Hills client obviously achieved maximum growth through good advice and paying LMI. You said that you and your brother treaded water for about 10 years. So I just want to look at those side by side. Presumably you did not use a buyer's agent. You guys purchased independently. So you've saved your LMI and you've not paid a buyer's agency fee. The Surrey Hills client, do you know if they used a buyer's agent or if they got advice from other people?
They did seek advice from an actual buyer's agency at the time.
Okay. So the second purchase, or the client who purchased in Surrey Hills, got advice from a buyer's agent and paid LMI.
Correct.
So they would have paid $25,000 odd in
potentially, yes.
LMI and professional fees.
Absolutely.
And a lot of clients fear, another $25,000 on top. But just those two examples there, you can quite easily see how that can be justified.
Absolutely. By fast forward those 10 years, the Surrey Hills apartment was a far better investment than an actual property in the suburbs of basically Sydney.
And how is the average person supposed to know whether to buy one over the other?
Well, and that's where the likes of like you guys come into it, to be able to give those clients the right advice.
Yeah.
Because the right advice makes all the difference.
Yeah.
You know, and it's and having that advice, speak to your financial planner, speak to your accountant, speak to your mortgage broker, because everyone's got years and years of experience.
Seen it all.
Absolutely. And then you can use all those skill sets to be able to make the right decision. But make the decision. Don't sit and procrastinate. I've had plenty of clients that have come to me, I'm thinking about buying. Then they come to me 2 years later, I'm still thinking about buying. By then, that the market's moved. And so what they could have bought 2 years ago, that they can't buy now.
Yeah.
So make the decision and make it fast.
With the right advice, and then you can feel confident.
Exactly.
Yeah. So what if listeners out there, hey, they're saying, hey, I've already got 2 properties right now.
Don't stop growing. Don't stop driving. Continue to build your wealth, because so many clients that have gone halfway through this plan, halfway through this journey, fast forward 5 or 10 years, that the market's kicked, it's moved, then they're priced out of that market. I wish that I stretched myself back then to get that 3rd or 4th property.
Yeah. Okay.
Because having that compound effect, you know, and we always think that the property market has done its dash, and that's it. Now we're going to be following other countries and having a stagnant property market for the next 10 to 15 years. But with this strong immigration that we've seen over the last few years, strong growth prospects, we are a growing nation with like limited land. Find the opportunity, find the markets that have still got opportunity to grow, and invest there.
Yeah, definitely. It's
so fear of risk versus fear of aggression. Where do you sit on that?
Look, it's scary when you're saying, I'm going to take on more debt, another $500,000 worth of debt, $700,000 worth of debt. That's a really scary decision. But I think you've got to put your faith into your expert panel, your expert advisors. Look, don't stretch yourself too far. Still feel as though that you want to put your head down on your pillow at night and sleep comfortably.
Yeah, it's important.
Yes.
It's definitely important. Enjoy the journey.
Yeah, enjoy the journey, but put your faith into those advisors.
Yep.
Buy places, you know, we saw obviously during the COVID pandemic, rental yields were smashed in certain locations. I know that client that bought in Surrey Hills, they still own the property. During the pandemic, they had to reduce their rent because their rent was geared towards students that were attending their local university. That was their main market. Take the advice, buy in the right location, buy where there's got strong owner-occupied families, buy where there's low vacancy rates, and then that would buffer and nurture you through those difficult times.
Yeah. It's funny. I have seen recently an ad on social media. You know, the guy was saying, you know, it's a silly thing to be buying around school zones and everything. And me and Manda totally disagree, because I know I'm going off subject now, but the point is, you do want to be sticking to schools and having families, because they're the ones who are the longest tenants staying in that house.
We try to stay away from transient areas like universities, because you don't have people setting down roots in those areas. Whereas near a local school where you've got families that are committed to that catchment,
absolutely,
you're more likely to keep them in there long term.
You want to be close enough to the school where you don't feel any traffic pain or actually hear the noise of the students.
Yeah.
As long as you're kind of close enough, it could be very advantageous.
And often people say to us, but they've got 3 kids and a dog, they're going to trash the place. And we go, you know what, if they're there for 10 years, it's due for a paint and carpet anyway. Let them live there for 10 years. You've got 0 vacancy. They'll pay their rent. They're not going to go anywhere. What if you need paint and carpet?
But also choose the right property agent. Choose the right property agent that's going to do their job, do regular inspections. It's all about risk mitigation. You want to just have the right governance in place, have the right factors so that you are reducing the risk of that property being damaged.
And anyone out there who's investing should have landlord insurance. So
absolutely.
If someone does trash your place, you get a free renter.
You mentioned something just now, Samuel, about risk mitigation from a broker's perspective. Because, people come to us and they say, look, I can borrow this much, but I don't want to borrow to my maximum. As a broker, people that borrow to their maximum versus those that avoid borrowing to their maximum, I've always, spent every cent I've been given by a bank because it's the bank's money, not mine.
Absolutely.
But people fear that.
Yes.
What's your perspective?
Do the right budgeting. I've always sat down with my clients. I think coming from a kind of tax background, you sit down with your clients and you talk through their whole budget. Look at not just income, but look at their actual expenses. Do they want to go on a holiday every year or every second year? So how much put aside an actual budget for that? Once you've accounted for all of that expenditure, actual and forecast, then see what they've got left over.
Yeah.
So there is ways you can have your cake and eat it too with the right advice.
And on that note as well, we talk about cash flow. Your modelling, your 15-year modelling is on principal and interest loans.
Yes.
I want to touch on interest-only loans from a cash flow perspective, but also a risk perspective. Your modelling is very conservative. It's principal and interest. As investors, we like to stick to interest only. Yes. We don't like to give the bank more money than we have to. But again, as a broker, what's your take on interest-only loans from cash flow and risk?
Interest-only has changed over the last 10 to 15 years. And I think it's important for all my applicants to understand that it's fantastic when it comes to cash flow for an investment property. My first protocol would always be to try to preserve the debt, pay down any owner-occupied debts first, preserve the investment debt because that's obviously has got all of the tax benefits associated with that. That being said, lenders have become a lot more conservative over the last 5 to 10 years around interest only. And so they often won't, the lending won't be as generous as a principal and interest loan, or they may not give as long as interest only term as well. So may only give 2 years rather than 5 years. So you just got to take into account all those factors into account. I think as a first protocol, try interest only because that will maximize. If you go interest only, you may be able to buy that fifth property in year 8.
Yep.
Yeah. But that being said, you aren't paying down any of the debt.
Yeah.
So you just got to be smart around having offset accounts. So all of your rental yield that you're putting into those offset accounts. So at least it's working against those home loans, but at least it gives you the opportunity to go and stretch yourself again to buy that fifth or sixth property.
All right, so we've looked at interest only versus principal and interest. Is there a difference in interest rates on those?
Yeah, that's another important factor. Once upon a time, whether it was interest only, principal and interest, whatever the actual loan to value ratio of the property was, the rates were the same. Those days are long gone. The banks, where they may have had 5 products once upon a time, now have 20 to 30 products because they split on loan size, they split on loan to value ratio. They also split on principal and interest versus interest only. So generally what you see is an interest only rate is generally 0.2% to 0.4% higher than what the principal and interest rates are. So it's important just to take that into account that you will be paying a high interest rate for the benefit of having an interest-only product.
And your 15-year modelling, what interest rate was that calculated on?
I've calculated that on 6% because that's the kind of like the long-term average.
Which at the moment we can do better than, can't we?
Correct. So as in the market right now, we're seeing interest rates of roughly about 6 to 6.05%. You actually can get it down into the 5s at the moment as well. Something in that realistic rate of 6% is achievable. And that's the thing, I've made sure that I've actually stress tested this model to say, well, at owning those 4 properties based on the values, based on the rental yields, is that achievable? Yes, it is.
And if we look at what can be toggled, say the interest rate does go above 6%, well, the rental yield may also go above 4.5%.
Absolutely.
So we're still in that safe zone, aren't we?
Yeah, because you do often see that the rental yields do tend to mirror what the interest rates are. So when we saw interest rates plummet after COVID or during the COVID period to that 1.8, 1.5%, the rental yields followed as well. So you saw yields down to like 2% in Sydney.
So the big question, Samuel, this 15-year plan sounds too good to be true. What are the risks?
Well, look, that's it. The risks are obviously that if the banks decide to drastically increase their actual interest rates, that we have another pandemic, that your property may become vacant for a period of time. I think by having the right risk mitigation strategies, have landlord insurance to cover the case of a property being damaged or if there's a long period of actual vacancy. Correct. Consider if you want a bit more comfort around interest rates, consider an actual fixed interest rate so you can at least have that level of comfort. At the moment, we're seeing 2-year interest rates for investment purposes around about 5.5%. So that is significantly lower than the 6% that I've used. So there are options available to help mitigate that risk, to give you that greater level of comfort for this strategy.
And I think as well what is easy to forget is that if that is the blueprint and the plan and we're already outperforming the numbers, you're building the buffer in with that overperformance as well.
Absolutely. So as I said, I've based my rental yield on 4.5%. If you're able to achieve 5 or 6, 7%, suddenly that's cash in the bank. So you are building up.
That's buffer.
Yeah, that buffer, just in case something adverse does happen. But also having 4 properties in 4 different markets, but it provides a natural diversification and buffer as well. So you're not being exposed to the same risks.
Putting all your eggs in the one basket.
Absolutely.
And we can structure the strategy to the individual's circumstance. So
correct. This is where portfolio planning comes in because, as you said, 4 properties, 4 markets. Therefore, you've got to purchase in the right order, in the right market at the right time, with the right broker who can secure finance, not just for the first, but for all properties, and portfolio plan from day dot, not just wing it as you go.
And I would just say, look, just don't forget your superannuation fund. That's often a pool of funds, a pool of cash that my clients don't even really realise that they even have. Depending on those balances and getting the right financial advice, there may be an opportunity to potentially convert that from an industry fund into a self-managed super fund and buy your 4th or 5th property via your actual self-managed super fund. But obviously, I would encourage everyone to get the right financial advice there.
So this plan is certainly accessible for almost anybody.
Absolutely. But I just would always say the applicants have to have the right discipline as well. They have to have the right drive. As long as that you want to build your property wealth, you have the right mindset, anything is achievable.
For sure. With the right plan and the right advice.
Every dollar that you can save today will be a dollar well spent tomorrow. So make the sacrifices today. If you can cut your expenses, maybe instead of buying a more modest car or saving on the actual holiday, if you can, if you can start with by saving a deposit of $50,000, then that will at least get you a foothold into the actual property market.
I love that you mentioned purchasing a modest car. We often laugh about my dad's advice in these podcasts, and one of his favourites was drive the cheapest car your ego will allow.
Yes, indeed.
And to this day, I continue to do that. It's a very hard habit to break. I still drive a little manual, because it gets me from A to B.
And don't underestimate financial habits. You get into those good financial habits that maybe instead of going and buying your morning coffee, you bring yourself down to a cup of Nescafe.
I love my Nescafe.
Yeah, exactly.
I think the key word there is habits.
Yes. Good financial habits. Making those little small micro habits can amass into something really massive.
Actually, you've reminded me of, particularly as we age into life, that lifestyle creep. I mean, you would see a lot of clients where you've maybe been with them for a number of years, where as their salaries have gone up, their expenses have gone up.
Yeah, absolutely. And you see that the lenders actually even factor that into their borrowing capacity, that, a couple that may be on a household income of $300,000.
Yes.
We often see that their living expenses are significantly higher. The nicer holidays, the nicer finishings of their actual of their properties. Anywhere you be, or the more extracurricular activities going out, the more dinners, the little sacrifices you can make, it's small things, as you know. So, you know, bring your lunch from home rather than then go and buy it. You know, do that, you could save potentially $100 a week.
Yeah.
Instead of driving to work, catch public transport. You can, you know, we know obviously living in the cities is expensive with tolls. Anything where you can save $10 here, $5 there.
It all adds up.
It does, doesn't it?
Absolutely. It's incredible. Even things like hand-me-down clothes for the kids, you know, daycare clothes, they don't need to be brand new.
No, exactly.
When you've got friends or family, I mean, so many kids' clothes go to waste. They outgrow them so fast. Little things like that.
And the only other thing I would say is that find a good network.
Yeah.
Because you tend to reflect your closest friends and family.
That's exactly
You are
right.
the average of the 5 people you hang around the most.
Absolutely.
Samuel, thank you very much for today. It was a great chat. Amanda, thank you very much. And for all the listeners out there, if you wish to download the ebook, the link is below. Please feel free. I'll also add a link to Samuel's contact details, which will be at the bottom, of course. And feel free to book a 15-minute discovery call with our staff or myself. And we will also have that link below. Amanda.
Yeah, just on the ebook, if you guys decide to download that ebook, just to explain how it's laid out, what we've actually created with Samuel at Mortgage Choice is the 15-year blueprint using the model that Samuel explained today. So that 250K income, the 6% growth, the 4.5% rental yield. We've actually built an ebook with Samuel that lays out the 15 years, one page at a time.
Yeah.
So it's really easy to understand. It complements what we've discussed today. And if you do want to toggle any of those variables to your own situation or work out your borrowing capacity or timeline, you can reach out to any one of us to personalise that for yourself, start your property journey, work out your finance and use that ebook as a sample, but also come to us if you want that personalised for yourself.
And keeping in mind that ebook can be structured to your personal circumstances, so that doesn't mean it has to be over the 15 years. But that's a discussion to be had with us. Again, download the ebook, book a free 15-minute discovery call with us, and we'll see you then.
Thank you.